Stock started 2018 with maybe its best start ever, at least the best start in a long, long time. So what does that mean? Does that change our expectations that we have heading into January with the Santa Claus rally and the January effect? So I'm going to break all that down, how that impacts expectations for large caps versus small caps. I'm also going to show you one sector that's really been beaten up more than probably it should have been, and we're going to talk about see if we can take advantage of that. So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Wednesday, January the 3rd, 2018. Thank you very much for watching tonight. Welcome to those that are watching for the first time. You'll notice the name of our new company at the top here, Market Scholars. You'll see our website as well as my new email address, david@marketscholars.com. Of course, Brandon's would be brandon@marketscholars.com. Subscribe to our YouTube channel by clicking that red subscribe button right down there below the video. You can do that right now while you're watching. Also, while you're down there, hit that thumbs up icon. That lets me know that you liked it, that you want me to do again tomorrow. Scroll down further, comment on anything that stands out to you. Love to see what you're picking up, what you're learning from these videos day in and day out. In the video description, there's a few links down there. Subscribe to our daily email newsletter for the Market Outlook by clicking on that email subscribe link down there. You can follow me on Twitter for more content I put out there throughout the day. You'll see my handle at the top of the screen, @DavidSettle42. You can also like and retweet tonight's Market Outlook tweet that's always pinned to the top of my timeline. By doing that, you'll make sure that Twitter continues to keep pushing my stuff out to you. Also, remember to join our Market Outlook community on Facebook. I'll start getting better in the habit of posting the same content I put on Twitter on Facebook too, because I know a lot of you are on Facebook but not on Twitter. So I'll get better at that habit. But I put a lot of stuff out there today, so make sure you're following so you can get that content that I try to put out that connects these videos from day to day. It's more content that kind of supports what we're talking about here. All right, well, let's take a look at the S&P 500 with a market forecast indicator. See what we're doing right off the bat. Flirting with a cluster, an overbought cluster, which again takes on more significance the longer we've been bullish. Right, a cluster within the first month, not as big of a deal. In this case, a month and a half, not as big of a deal, even though they did produce more volatility there than a cluster in the 4 months in, right? Especially when the typical time frame is 1 to 3 months for an intermediate run. So we are, 4 months into this. We're past 4 months into this now, going on a 5th month, and the near-term line is the high as it can be. That's a strong bullish. The near-term line now, including last week, has been above 50 for 4 days. So here's our 4 days. Again, the typical time frame for the blue line to be above 50 is 7 to 12, and the idea with increasing near-term volatility would suggest that we probably won't get the 7, 8, 9, 10, 11, or 12. We'll most likely kind of be in this 4, 5, 6 day range. Now, it helps that it's still that it got up strongly, but you see that one got up strongly too. Didn't last 7 days. We basically got up, and you can see we didn't drop either. We didn't even test it. We didn't come close to testing the 30-day moving average back here in mid-December. So it doesn't, just because the near-term line, we don't expect it to stay up for too long, doesn't mean that it's going to go down significantly either. It's just going to be more ups and downs as this intermediate trend starts to pull back and produce a new intermediate low point, and then the market sentiment line also pulls back too. So really strong move today. The last couple of days, a really strong move. In fact, I saw one tweet that said that it's the strongest that we've had to start a year. It's the strongest 2-day period that we've ever had. Now, I haven't gone back and tested that myself, but that's the suggestion. And the idea being that the Santa Claus rally, so the last 5 trading days combined with these 2 trading days, good rally here. Would suggest a good January, and a good opening day on January suggests a good year. So that's kind of like the January effect. One thing I tweeted out is I'm not too, let's see, where was that one? And you can see I was pretty active today. You remember, to make sure you're getting all my tweets, you have to like them and retweet them. Again, even if you don't have followers, the more you like and retweet, the more Twitter keeps saying, okay, well, there's an account that person likes to engage with, so we're going to keep pushing all the tweets from that account to that person. And again, they'll push the tweets that they'll push the most will be the ones that have the most engagement. And that's why, again, one of the things I suggest is always liking and retweeting the pinned tweet to the top. And then again, anything you see, when you click a like, obviously it helps you because it keeps pushing you my stuff if you want to get it. And number two, it helps me because it's what you're telling me with that like is keep tweeting stuff like this. I appreciate it. Keep doing more like this. And again, one of the things I tweeted out was not to, where was it here? It was earlier today. Here we go. Little wary of the impact of this Santa Claus rally, because the difference is, the last time we've been this bullish in the first 2 days was 2010. The difference between 2010 and here is we were only a month into an intermediate run back then, and we had a good January as a result. This time, however, we are 4 months in. So I'm kind of looking at that as a head fake, and actually looking for more of any benefit to come from the January effect to impact the small cap index, because it's been the one that's been lagging. It had a horrible quarter relative. I mean, obviously not on an absolute basis. You can see on an absolute basis, there's where we closed September at 147.5 roughly, and then we closed, the year at 152.5. So, I mean, it wasn't a down quarter for Russell, but compared to the S&P 500, the S&P 500, which ended September at 250 and ended the year above 265, was about 267. That's a pretty decent run. So IWM really underperformed the broad market as a whole. So if anybody's going to get any benefit, and remember too, the Russell 2000, it's had an intermediate low point more recent than the S&P. See, they both crossed. The S&P actually crossed a little bit earlier at the end of August. But that's where they both crossed above 50. And on this pullback here in November, from the beginning of November to mid-November, it really brought it was a much, much bigger pullback on the IWM than it was on the S&P 500. See, the S&P 500 basically just got to the 30-day moving average, brought the intermediate line down to a weak bearish posture, but not below 50, which is what you need to start a new intermediate run. So that's why we're getting a good. This is basically a continuation of this run, whereas in Russell 2000, it's a new one. We did have more of a pullback, and that's why it's lagging behind the S&P so much, because it dropped so much more during that weak November pullback than the other major indexes. So that's the index I would expect to get more of a January effect bonus from. And you'll see today, I'm not expecting much of a continued move like this. These 2 days right now might have, and I've used this analogy before, but might have pulled forward a lot of bullishness into a couple of days, and might eventually end up sparking that intermediate grind pullback. And again, another tweet that I put out there, actually, let's see what I hear as a reply to this one, to remember, you don't get major reversals from all-time highs. So when the market's at all-time highs like this, it doesn't spark major reversals. It sparks a change of trend to a weak bearish posture. And as it grinds during a weak bearish posture, then it might fail to get a new higher high at that point, and we will have a bearish trend. Market sentiment will be falling. Then you'll have the possibility for more of a deeper pullback. Which again, I would expect more to happen in the late spring, early summer timeframe, where you seasonally get that type of weakness. You can see the Dow Jones also closing with new all-time highs, also with close to a cluster. The NASDAQ Composite, which a lot of these big tech names have been leading a lot of this market move in the last couple of days. You'll see here a little bit later in the video, came really close, only a little bit off the intermediate line from getting a new overbought cluster there. And IWM was the one that I pointed out earlier in the day. It barely, if it would have closed at the high of the day, the momentum line would have been up there, because it was been flirting all day with that. But coming down, you notice still trading below the high on December the 4th. So that December 4th high still holding some resistance there. So again, if we're going to get a January effect, a positive return on anything, I would expect IWM to, if it doesn't go up on an absolute basis, to outperform the S&P 500, because it's lagged this whole 3-month period here. It's had a big lagging performance, even though it's up. still lag behind. And a lot of people have been moving into, especially that energy and material space. So continued strong bullish posture, strong near-term sentiment, too strong that I expect now that we'll get more choppiness. We'll get some more near-term ups and downs. And I wouldn't be surprised if the rest of the week we start to get some more of the near-term down as we were very overextended with this 2-day strong rally that we've had so far in 2018. The long-term view continues just to look very bullish, and I continue to show this to remind you that we will not be significantly bearish when the MACD of the 50 and 200-day moving averages is this high. We haven't in the past. We wouldn't expect it to be again in the future. Again, barring some kind of anomaly at obviously the markets. It was kind of funny on TV today. I heard people asking, what unexpected thing can come out and derail this bull market that we're in? And the response was, so you're asking me to come up with something that's unexpected that nobody knows about right now. Otherwise, the market would be pricing it in. So we don't know. We don't know what unexpected things there are, because even the things that we can anticipate being black swans, the market can anticipate. It's not like we have a monopoly on thought out there in terms of what can derail this. Every analyst, everybody's got thoughts on what could derail this market. And right now, the odds of those potential factors impacting the market negatively are really low, and the market has priced those in. That's why we're continuing to go. That's why the VIX is as low as it is. You'll see in a second. If any of those potential factors that's currently unexpected becomes expected, the market will start to price in those expectations. And so right now, according to what the market's expecting, there's nothing right now that would derail this. That's why we're as bullish as we are, and that's why you don't turn from strongly bullish to strongly bearish. You'll start to get arrows, right? You'll start to get a lot of arrows, which means you're flirting up and down week by week with that 50-day moving average, while the gap between the 50 and 200-day moving average starts to shrink. So we're not even getting, since the golden cross and then the couple of tests of the 200-day moving average, we've only gotten 2 red arrows. And we've subsequently bounced right back the next week above the 50-day moving average. And they're very evenly spaced out, so there's nothing here that would suggest any kind of major pullback yet. But the fact that we are so high above the 50 and above the 200-day moving average on a price basis would suggest that it's going to be kind of hard to maintain this pace. We've maintained a pretty strong pace for more months than what you would expect based on the technical indicators that we look at day after day. But the trend still continues to be bullish. So, again, if there's any doubt or question about where the market could go, you go with the trend always. So the trend's still bullish. We trade according to the trend. But the length and everything we talk about in terms of factors that could produce some near-term pullbacks would tell us, again, trade with the trend with the proper risk management, accounting for these risks. The risks that were so high above the moving average, it's just a risk. It's a potential risk. And potential, as you know, as sports fans know, potential means you just haven't done anything yet. The market hasn't done anything yet. Doesn't mean that we can't account for those risks, not by avoiding any bullish trades, but by managing our risk differently on new bullish trades and current positions relative to where you would have managed them coming up a lot closer off the 50-day moving average, or a lot closer off a low point with long lower shadows below the 200-day moving average. From a 3 green arrow standpoint, we're back to almost getting 3 green arrows. And again, we've talked about this before. When you are this high above and the MACD is this high and crosses below its moving average, you'll notice it will come and retest that moving average. Came a little bit closer there. This one, I think it might have even crossed above it a little bit, crossed above it here. You'll get tests of that moving average. I wouldn't expect this to cross above it and continue up to new highs on the MACD. I expect that we'll continue to grind up and down as we move towards the 30-day moving average, and the 8-day moving average moves towards the 17-day, which is the basis for this black line. As it crosses the 0, that means the 8 and 17-day moving averages will get closer to each other, like they did right there. So you get an expansion away, and then we just grind higher. We get a good strong move. So here you can see when that MACD came above 0, we had a good strong rally up to that point where the MACD got up in the beginning of August. That was a good move. And then from that point on to this low point, you can see we still moved higher, but we're grinding. And there's a lot of down days in there. We were flirting around with the 8 and 17-day moving average, finally tested the 30-day, made another strong run to get to this point here, and now we'll start to grind. We've had a good couple of days here and expect that we'll come back towards the 8-day moving average, especially considering how far up above the 8-day moving average we are right now. And continue to expect that MACD to slowly, by the end of January, make its way closer and closer towards that 0 level, if not crossing. I wouldn't expect it to cross below 0, but because you can see it takes a month and a half for it to get from these lofty levels. Here it was a little bit less than a month, and that was mainly because that one down day right there where my cursor is. So I would expect that we'll continue to grind by the end of the month towards 0, if not touching it by then. And to show how significantly bullish today's move was, look at the range. So we had, this was yesterday coming out of the holiday, and we had a pretty big volume and big trading range day on the last day of the year of 2017. So we bounced right back up 2018, closing above the 4-week high over here, and then of course bursting up through that 4-week high by another almost 2 more points. So this actually needs to move now. This 4-week high point, and let's get it to a 4-week chart. So we'll move that all the way up to the high today, and you can see the low point. So we got quite the gap now again, and again that offers us the opportunity to move this up and buys us time before we start to grind. Again, the bigger pullbacks occur when the gap between the 4-week high and low are tighter. And so again, that won't happen until we get through here, 2014, and we get up to where this is the low point. 266.64 will have about a 4-point range, barring any more moves to the upside. So again, another reason why not to be significantly bearish, because we're not trading in the lower half of the chart yet, which has to happen first before we get any kind of major pullback. And again, and this range would have to tighten first. And again, we're trading a lot closer to the 4-week high than we are to the 4-week low point. So again, default to the bullish side. Just account for, that's a big range. We have a big range right now. Typically things slow down when you get to a big range. See how we moved up really quickly there? It was a bigger range before when we got to 268.50, and we went sideways for a while. So that's the kind of move I'm expecting now. At best, is more of a sideways kind of action. Maybe not that long because that was Christmas week here, but something like this over the next 3 or 4 days with maybe a little bit of a downward tilt. Taking a look at the range and the volume today, which are both on the high side. Give it a second to load up. Here we go. So volume back above average at 88 million. And the range today, 1.68 points. Account for the small gaps. You're about 1 3/4 points there. Put that in the context. 1 3/4 points is up here. 88 million shares traded is up here too. Those are not good bullish moves. There's no resistance. It's not like we have multiple touches here at 270 that we need to get through. Right? So there's no significant resistance that we need this big of a range and volume to get through. So what that's telling us is, these are bearish. These last 3 sessions, they're high volume, high trading range days. And then when you look at the divergence that it's having with the volatility, which is very, very low, so that the volume in the trading range suggests bearishness, because usually bullish trends, those get smaller, the ranges get smaller, the volume gets smaller and smaller. But you can see the volatility index is not reflecting any kind of bearishness. It's at an extreme low. Now, keep in mind, when it's been closer to 9 in the most recent history, it's popped right up to 13 there, and it popped up here, barring the Santa Claus rally. That bullish typical seasonality kept it from going too far up, but it did go from 9 to 11 almost. So pretty decent move, almost a 20% move in the index there. So and then of course the last time all the way from 9 up to 13, all the way up to 14 actually on an intraday basis. So we expect the volatility this extreme low, and then see, here we go. Looking at it on this chart, below 75%, you can see that's something else I tweeted out today as well. When the VIX has been below 75% in the past, this is what's happened. We spiked up to 14, from 10 to 14, before coming back down again. Here at the beginning of October, we moved up from about 9.25 up to 12. Again, at the beginning of November, we moved from 9 up to 13, up to 14 on the intraday basis, and here we are again. So there's precedent for it to be this low, below 75%. We've seen what the volatility index does immediately, almost immediately when it does that. So another reason why I expect more near-term volatility and near-term pullbacks, because volatility is extremely low, and we're not getting small volume and small ranges. We're getting bigger volume and bigger ranges. So that combine that with this, combine the divergence of bigger volume, bigger ranges with low volatility. So combine that divergence with just extremely low volatility all by itself, and that would suggest near-term volatility, near-term pullback, not bear market, not even an intermediate low point in the next few days, right? By the end of the month maybe, but the fact that we're moving up as high and as fast as we are, I think we kind of run out of gas. I think we've made a good move. It's like when you ride horses and you're riding back to the trailer and they know that they're almost back. They're tired, but they make a nice good run to get back there because they know where home is. The market's kind of done the same thing. Okay, it's tired. It's 4 months in this intermediate run. It's almost home, so to speak, almost to the end of its run. And at the end of its run, when it's tired, last good strong push. And now we'll just kind of coast in and start to grind again with this weak bearish posture towards a new intermediate low point. Of course, that's my expectation. Doesn't necessarily mean it will happen, because you can expect. That's why we use stop orders. That's why we use risk management, because not everything happens as you expect. But you have to have some expectations. You can't just go willy-nilly into the market day by day and assume that it's going to be that you're not going to have any idea what's going to happen. We base our portfolio management, our positions trading based on this top-down approach that we look at every day on the Market Outlook video. So having this top-down approach builds those expectations, and then we trade accordingly. So now let's transition to what's driving the action today. As always, this is the time I like to plug in to follow me on Twitter. Today I put out a lot of charts, a lot of different charts. Was kind of in the mode today. And so to make sure you are getting this content, that I always try to connect to what we talk about day after day in these videos. You go to twitter.com/DavidSettle42. Follow there. If you need to create a profile, you don't have to actually tweet. You don't have to do any tweeting yourself. You can just follow people. That's how I started out on Twitter, whenever it was, 2010. So you can just follow people. Like I said before, make sure you're liking and retweeting, especially this pinned tweet that's always pinned to the top of my timeline, the most recent Market Outlook. That way, the more you engage with my stuff, the more Twitter will keep pushing you my stuff. And if you need people to some ideas on who you can follow, I have a bunch of public lists listed within. You just click on lists, you'll see all my public lists there. One of my public lists is this financial trading. I've got about 352 people that I follow on there. You don't have, some people subscribe to the whole list, as you can see. You don't have to follow all 352 people, but at least it gives you some ideas on who you can follow. There's some great accounts on there to kind of help you keep track of what's going on in the markets. That said, the news of the day today, you can see from an economic standpoint, was the FOMC minutes. Again, talk of this gradual pace of rate hikes, especially with the fiscal accommodation that we're seeing from the tax reform, the tax cut bill, as well as the potential for infrastructure bill at the beginning of the year here. You can kind of see, we've got a really high economic surprise index still at 78. You can see the global economic surprise index is higher than it's been, since 2009, when we were coming up off of its lowest point, ever here. So, you make that big run, and now we're about that high again. So, very positive economic data, but today's data kind of shows you the discrepancy. So, you can see a ISM number, which is a survey figure. This is a survey of businesses on how bullish they expect to be, essentially, about the economy. And you can see that really high figure, if not the highest that we've had. But then, so that's the sentiment survey. That's what people answer on surveys. Here is some hard data on construction spending, and you can see the year-over-year figure, which what matters, is still really low compared to the end of last year. Still positive, but still very low, lower than it was in the middle of 16. So, and remember that Trump was elected right here at the end of 2016. So the soft data, which is the survey data, very strong. Actual data, in terms of actual construction spending, not so strong. Now there's other actual data that's helping keep estimates at 3%. But again, as you've seen, this is a website I always like to go to show you how the GDP is put together quarter after quarter. The last 3% growth was not coming from consumer goods and services, which is where you want it to come from. It makes up 70% of the economy. Most of this growth came from inventories and a lack of imports. See, imports, the more we import, that actually brings GDP down, because that means other people are producing it. Exports is what adds to our GDP, because we're producing it and shipping it. Imports, somebody else produces it, so it helps their GDP, and we're bringing it in. So it should take our GDP down because we're not producing it, somebody else is. And you can see there was the imports is actually a positive, which means we weren't buying as much stuff in that quarter from foreign sources. So it was, and it's very rare when it's negative. You can see the last few times it wasn't negative were really weak quarters in GDP. The only ones that we've had below 1%, and you can see here's another example of one that was really strong in third quarter of 2014. Where imports was also a positive. Now that one came from strong fixed investment combined with strong consumer. We just don't typically have that combination, and when we do, they're very strong quarters. Right now, fixed investment's very weak, consumers very weak, and so last quarter's third quarter 3% growth rate came from inventories and imports. That's not sustainable, and it's temporary. So now we're getting another 3% quarter estimate so far. You want to see it coming from these bigger sources here, investment growth as well as consumer consumption growth. That's where you want the growth to come from to lead to that 3%, not from not from government spending and not from trade. You want trade to be a negative, not a positive. Where it was a positive last quarter. So, a long way of saying this really positive result here is a big discrepancy between hard data and soft data. And the hard data is getting better, but is not where we want it to be to really sustain a persistent bull market. And again, kind of just shows that the maturity of the bull market we're in. We've had a good strong data, and it's starting to gradually move its way down. So we take a look now at what's the asset classes and how they perform today, and really the last 2 days that we've been so bullish from the close at the end of the year, and look at emerging markets and crude oil continuing to be the biggest movers to the upside. In fact, the only things outpace the S&P 500, but the S&P is outpacing small caps on 2 really good bullish days. In fact, like I said before, and I tweeted that out, I retweeted, the only time we've been this bullish on the first 2 days of the year, and small caps have been lagging behind on that. And you can see the dollar weakness in the dollar is what's helped contributing, and the weakness in bonds, so bond yields rising, and that's been the last 2 days. And just looking at today, again, not very many outliers, but crude oil continues to move. And I want to show you a chart of crude oil here really quick. You can see we're moving our way up. We've got the golden cross, 50-day above the 200-day moving average. This is a weekly chart. But you can see back here, and again, I in my Outlook video from last Thursday, I talked about that there's a couple of years that we can compare 2017 to, which would tell us more about what we should expect in 2016. Well, you can see how 2015 we're kind of working our way up, and by the middle of 2006, which is the year I compared to 2018, we eventually hit by the middle of the year $75 on crude before we kind of fell into the end of the year. It looks like we're making that similar run now, making our way up to $75. Now remember, the Fed raised rates from the middle of 2004 to the middle of 2006. So the Fed was raising rates that whole time, And then we're in an interest rate hike cycle now. Now, they stopped raising rates in the middle of 2006, a little bit of a pullback. Then the stock market eventually peaked right here at the end of 2007. So you notice, I mean, that was high crude oil costs compared to just a few years earlier when we were trading at 30. So don't expect, this $60, even $75 to weigh on the market. In fact, again, we expect commodities and energy to lead the market in 2018 and to be one of the outperforming areas and sectors. So not surprising that if energy is doing really well and crude oil is doing really well, that the energy sector is just killing it, continues to kill it. You can see just today, the last 2 days, the XLE is up 3.25%. The market up 1.25%. XLE Materials is killing it. Discretionary technology. I mean, this is a bullish setup. Industrials lagging behind a little bit. Usually like to see on the other side. But look at what's lagging. I mean, utilities. In fact, in today's email that I send out to everybody, again, subscribe to that email newsletter down in the description below. But you'll notice all of the oversold clusters pretty much all came from the utility sector. Real estate also, there's a few, but look at the staples. I mean, this is a risk-on move, not simply because all these sectors are outperforming, which we expect, right? We expect energy materials to outperform. Technology and discretionary doing well. They started off strong, and then other sectors like healthcare and energy crept up. But it's risk off in the fact that people are not only buying into these areas, they're selling out of the safe havens because the safe havens are down 0.75% to 1.75%. When the broad market's up almost 1.5%. So, I mean, there really can't be any more risk on than this, which again kind of suggests that we are really moving pretty far, pretty fast in a matter of only a couple of days so far in 2018. That's not sustainable. That kind of move, those kind of numbers, again, in a small period of time, is not sustainable. Usually you'll start to see people value hunting for some of these areas, which are probably down more than they should be, especially like XLU. One of the things, again, that I tweeted out about XLU, let's find it here, was, where is it? One of the things I tweeted out on XLU here is right here, that it's below its 200-day moving average. So, I mean, look how far it's fallen in 5 weeks. It was well above its 50-day moving average. In 5 weeks, comes crashing down, relatively speaking, relatively crashing down. That's on an absolute basis. Look at what it's done on a relative basis to SPY in those same 5 weeks, 1, 2, 3, 4, 5, and even before that, coming down in the last 7.5 weeks, just really crumbling down to its lowest level compared to the S&P 500, compared to SPY in 5 years. So big, sharp drop. And when you look at it again back on the absolute basis, not only falling below its 200-day moving average, but also falling below 2 standard deviations below. I mean, we have like multiple sectors. I believe there's 4 of them. And here is XLE versus XLU, and you can see why there's a lot of potential in energy, compared to XLU. But if you look at, here we go, the 4 sectors, all 4 of these sectors are above 2 standard deviations to the upside. And the fact that XLU is 2 standard deviations to the downside suggests we have really pushed pretty far, pretty fast. I mean, look at that relative strength of XLE to XLU. Now that we've got the golden cross after multiple years of significant underperformance, now we're starting to outperform. Don't be surprised if we don't pull back a little bit now to that new rising 200-day moving average on this relative strength line. So you'll see some strength probably in XLU. It'll most likely be short-lived. It'll most likely occur during any kind of pullback we get. But it'll most likely be short-lived, while XLE provides a better buying opportunity, once this intermediate pullback is done. So for our trade idea, we'll take a look at one of the stocks in that utility sector that's really come down quite a bit, and that's the Southern Company here, dropping almost $5 from 51.5. Now you notice when we adjust for dividends, here it's gone from 52 down to 46, and you notice it's at its 52-week lows here, outside 2 standard deviations. You adjust for dividends, which means we get some extra return in here and not quite as low, but still very extremely low. And you take a look at like the long-term moving average, again, adjust for those dividends. You can see why 47 is a price we've hit a couple of times in the past 52 weeks, and bounced up sharply off of that. So okay, we'll give it an opportunity here. And you can see, man, this past few weeks has been a real big downer for 3.5 weeks, and really since the end of October. Big drop when the market's not dropping. The market's really, it hasn't been too aggressively bullish either. I guess it's been pretty bullish, but not to the extent that we should be selling off these utilities. So it's been quite the decline. And so we'll say, okay, well, we'll take advantage by selling a put at 46 and buying that 44. So it gives us about that 47 cent credit, which on a $2 wide spread gives us a 30% return on risk. It gives us a high probability trade. And we're getting decent. See, on utility stocks, we typically don't get this kind of credit. That's a relatively high credit because of how high or how much the stock has dropped here, and how much the volatility is. You can see that the current implied volatility is at the 64th percentile. So implied volatility is relatively high for the stock. Now you do have earnings. You can see there's an earnings report on 2/20. And you'll notice that these options expire on February the 16th, so right before that earnings. So we shouldn't be that shouldn't be too much impacted by those earnings. But we're getting decent credit because of how much it's dropped. We'll take advantage of that, knowing that if it were to go down to 45, we'll lose about $50, and we're trying to get $50 roughly. So we'll get a 1-to-1 return to risk. And if it gets to 55, which is where that crossover point is there, then we know that, okay, it's breaking through, this 46, and whether it's adjusted for dividends or not, we're breaking through those low points, that support, and looking for, it's the knife is still falling essentially. So we're trying to take advantage of the fact that the market is so bullish. We've gone up so much now. We're in that the extra innings essentially from a baseball terminology. We're 4 months into this intermediate run. It's been a real big risk-off move, considering that that we sold off these safe haven areas so much so fast. That we'll just try to take, with a lot of them coming down to support and to extreme lows, that we'll try to take advantage of that, knowing that it can keep going down a little bit because we're already at extreme lows. It can keep going down a little bit, and we'll still be able to hold until it gets to 45. Then we're out of it with a loss, no matter what day it is, that's similar to the return that we're trying to get, that by itself is a relatively high probability trade. And when I say by itself, I mean not looking at the technicals, not looking at the chart at all, just looking at current volatility levels and current pricing. All right, so thanks for watching, everybody. I appreciate your time tonight. Remember to subscribe, like, and comment down below on the YouTube channel. Also, remember to follow me on Twitter for more content I push out throughout the day, and join the growing Market Outlook community on Facebook in the address down in the description below. Hope you all have a great evening. We'll see you all tomorrow.